Hello and welcome to Pro Trader Strategies Market Commentary for the last day of February the 28th. My name's Eric Wilkinson. Some of you may recognize me as the Wolfman from CNBC, Fox Business, or even the Wall Street Journal for my commentary on everything from economic to geopolitical and market analysis. Please keep in mind that everything that we talk about in these market commentaries is not a solicitation to buy or sell any of these securities or strategies. At the end of the day, we're here to teach you some different strategies that you can implement into your portfolios, but please do that in your own way. The reason why I can't give you a recommendation on a particular stock or strategy is because I don't know your risk parameters. I don't know what's in your portfolios, and therefore what I'm doing could be counterintuitive to what you are already doing. And please remember that past performance of any trading system or methodology is not necessarily indicative of future results. All right, having all that out of the way, let's get it on with some economic data. We actually have quite a bit of economic data to talk about today, some actually pretty important economic data points. Let's talk about yesterday, for instance, overnight for us. We got Chinese manufacturing PMI came in at 50.3, which is the lowest reading we've seen since basically the summer of 2016, so about a year and a half now. Just barely, treading water above that 50, which is the line in the sand. Anything above 50 is expansion. Anything below 50 is contraction. It's at 50.3. We are right there. Any type of revision could actually put that below 50 and make it start looking like that we are in an economy, at least for China, contracting. That's not good for economies of scale for the most part. All right, now back here in the United States, we got French consumer spending came in at negative 1.9%, expected to be 0.5%. We also got Japanese housing starts came in at negative 13.2%, expected to be a negative 4.5%. Then in Europe, we've got, back to Europe, I should say, we got the German unemployment change came in at a negative 22,000. It's expected to be a negative 17,000, so less unemployed, better for the overall economy. Europe, we also got CPI flash estimate year over year came in line at 1.1%, expected to be 1.1%. Then we got core CPI coming in at 1.0%, which was in line with expectations. Then on here into the United States, thought there was a real. Hold on a second. I thought there was one that I really wanted to talk about across the pond. Not seeing it right now. Anyway, back here into the United States, we got preliminary GDP coming in right in line with 2.5%. Price index for GDP came in at 2.3%. Chicago PMI came in at 61.9%, lower than the expected 64.2%. So not good on the economic front there. Pending home sales came in month over month at a negative 4.7%, expected to be a negative 0.4%, much lower than expected there. And they revised last month's number down slightly from, it was not much, 0.5% to unchanged, so or to even, no change. That being said, that housing number is not good, you guys. Fed increasing interest rates, causing people to hold off on buying homes. It is the winter. We should expect home sales to kind of slough off a little bit, but that is much bigger than expected. Not good. All right, here in the United States, again, we got the crude oil inventories came in at 3 million barrel build, expected to be a 2.4 million barrel build. We're the second leading producers of oil right now. Russia, United States, then Saudi Arabia. That's a pretty big coup, if you will, that we are that high on oil production right now. One thing with this oil production numbers, remember we've been talking about going from one bucket to the next when we're distilling these products. We saw with the with the products, gasoline rose quite dramatically. As a matter of fact, gasoline rose by 2.48 million barrels. It was expected to be a rise of only about half a million barrels or something like that. It was actually gasoline stocks rose by 2.5 million barrels. Was expected to be a drop of 190,000 barrels. We also got distillates. Distillates actually fell by 1 million barrels. Expected to be a drop of about 100,000 barrels. That being said, distillates is heating oil, diesel, and like polypropylene and things of that nature once they split out all of the products there. So those dropped, which would lead one to believe that a lot of that's going into manufacturing. Heating, we did see a lot cooler weathers across the Midwest, and with the snow and everything else, that could have driven some of that as well. So, all right, on to the overall markets. We've got a real mixed bag across the boards. We got crude oil coming off a bit, about 70 some odd cents after yesterday settling below the trend channel here. I talked about that. It was going to be pretty bearish. It's going to act as a lot of resistance right in this area, or support, I should say. But now that we've kind of gotten below it as resistance. But all of this is going to get a little mucky because we're right between the 50-day and this trend channel, 9-day moving average right there. We are above the 9-day moving average, which is short-term bullish. Could just see this start to fill in this little area right here, or even all the way down to here, and build up a nice little area, or a nice little node, if you will, kind of like what we're seeing here, and build in this area. With the overall economy, us producing a lot of oil, gasoline, inventory is moving higher. Seems like the path, at least resistance, is the downside with crude oil, especially. We're not seeing great, robust numbers out of China, United States, Europe. All of these things being said, it seems like the economy is starting to be on a precipice of wanting to slow down. We've got to be diligent in not letting that happen. Gold futures making a little bit of a bounce after busting below the 50-day moving average. The 78 Fibonacci is acting as resistance right now. I think that's going to act as resistance and hold that. It looks like we've got a nice double top here in gold, broken below this support and the 50-day moving average support. One could say that the value area high could act as a bit of a support, but I'm looking for gold to come back down here, trade around that 1270 or 1280 mark. Still bearish gold, believe it or not. I don't really see inflation skyrocketing to the point that gold needs to move higher like that. All right, we've got Bitcoin futures down a couple hundred points right now, almost 300 points. Still in the 10,000 mark. We did try and trade up to that 11,000 mark, as you can see here. Pierced it for a brief second. That was the value area high acting as resistance. And then the overnight inventory after being long sold off to where we are now, which is right middle of the road for the most part, maybe close to the lows of the day. But I don't see Bitcoin really juking too far away from this point of control that we were seeing there. Bonds moving higher because we got a mixed bag in the equities. And I think it's a little bit overdone. Yesterday, we were seeing a lot of support here in the bonds. Late in the day, equities really started coming off. We were seeing some chart setups that I wasn't really liking. So I went in and basically covered all of my short puts in most of my stocks that I was squeezing those out for a little bit better than 50% of max profit. I decided to pull the ripcord on those yesterday. Just was not very confident in the market holding its own weight today after yesterday's sell-off. But we've got VIX moving slightly higher, not quite into the 20s, but we're seeing the VIX move higher and is above that 9-day moving average. So that is bullish for you guys that like to trade the VIX. I don't like to trade the VIX because it's a leading indicator. I don't like to trade the leading indicators. I like to trade the laggers. Why be one stepping in front of a steamroller is the way I look at it. And we've got the Dow Jones Industrial Average off by about 40 points right now, being supported by the 50-day moving average here. It's looking like we are going to see another little cross here, which is short-term bullish. NASDAQ unchanged right now, maybe slightly down, but unchanged for all intents and purposes. This is what I was talking about with this basic engulfing bearish candle right around this rally. We settled back down in the trend channel. Yesterday it looked like we were going to late in the day, so that's when I decided to start covering everything. Today, finding a little bit of a support, but these kind of supported, these dojis, spinning top dojis, when they're in the middle of a range, really don't act as strong as something that would happen at the bottom of a move. And this really is pretty messy right now. All right, E-mini S&P is down 5 points, 4 points on the day, being supported by the 23 fib here. And the 50-day and the 9-day all consolidating right there. That should act as a big support. If it pierces through that, all bets are off. It's going to be pretty darn bearish, because I think that we'd get under the 9-day, we'd be under the 50-day, and below that support area. Next stop would be the value area high, or somewhere right around that 2655 area in the mini S&Ps. Let's take a look at the breakdown. This is a 30-minute candle chart. Each segment, each candle is 30 minutes, and then each one of these blue sections is a daily chart. This is the last 15 days. You can see overnight, yesterday actually, let's talk about yesterday, right after I got done with the market commentary. The over market just fell out of bed. We were talking about how never tried to get overnight inventory flushed out of all of these longs. That's what kind of happened yesterday late in the day. Flushed out the long, flushed me out as well with my puts, because those engulfing patterns to me made it look like it was going to be very bearish, maybe even come down here and further. So I thought we were going to see a bit, we saw that big 10% correction, a bounce, and I was expecting to see maybe some more follow through with that going forward. All right, yesterday I was talking about Priceline. I basically had a brain fart. I haven't seen the news that happened like a week ago that Priceline was no longer trading under their old ticker, and they were going to Bookings Holdings, which is BKNG. They were saying that Bookings was the Booking.com was the company that actually saved Priceline, because Booking.com does much better overseas and across the pond. So Priceline bought them. Well, that saved them in their international travel, which is more profitable. So for that reason, I guess alone, they decided to switch from Priceline to Bookings Holding, or BookingHolding.com, BKNG, and they knocked it out of the park. They were expected around $14 a share, $16 a share, and you can see it blasted off. I wanted to sell the I think it was like the 16.95 puts in there. Was trying to hit the Priceline stuff and couldn't get it. Found out right after the close, figured it all out. Probably should have done a Google search rather than trying to reach out to TD Ameritrade. But that's that. That I didn't trade it. I didn't trade any earnings. I was trying to scramble to get my Priceline on and failed miserably. But in that, a couple of other things that I did. Netflix is something I added today because I was really short deltas, selling all these calls, things of that nature. I covered all my short puts yesterday. Decided to add some short puts, being long delta, because my deltas were very short. And when we didn't get that follow through today, I decided to do just that, neutralize my portfolio a little bit. So I went into the Netflix short duration March, sold the 265 puts in there for $1.29. All right. So gives me a little bit of positive delta, neutralizes my portfolio being a little bit more delta neutral. After yesterday covering everything, I was just very delta short in the overall markets because of stocks like Amazon. Amazon I had on the March, and I was short the 1,195 puts in there. Sold them for $385. This is one of those ones I was squeezing out quite a while. As a matter of fact, I think I did these back on the 14th on Valentine's Day. After we got this confirmation, I talked about it. I missed this bottom with all that volume right there. That should have been a sure sign. We came down, touched the 50-day, bounced off. As soon as we basically pierced above the 9-day, it was looking pretty bullish to me. It was confirmation twice. So I got in a little bit late when I realized it, and that's when I sold those 11.95 puts for $385. Got the market movement, got volatility to come out a little bit. Yesterday with that engulfing pattern, that's basically when I decided to pull a ripcord on it. So I bought them back for 67 cents. I was working those all day for 45 cents and decided late in the day to just pay up the extra 20 cents and get out. So you might be able to get out better than where I got out at this point. Volatility continuing to come out, theta decay working in your favor, and the market probably a little bit higher than where I got out. All those things working in one's favor if you weighted it out. Texas Instruments and another one that I had in my margin account, and I was short the March 99 puts. Originally sold them for 65 cents, bought them back for 29 cents yesterday. Again, same scenario. Probably get out a little bit better since I did mine late in the day towards the lows. But you can see again, we rallied up, tested this 23 Fibonacci level, and it failed. So that's a sure major resistance for Texas Instruments, ticker symbol TXN. So I think they are going to roll over. It looked like it to me yesterday that we'd get a little bit of confirmation. No confirmation yet, but I'm usually early anyway. On to UPS, you guys. Yesterday I was talking about XOM and I screwed that up. I meant UPS. UPS was the one that I covered on Monday, late in the day after the market commentary. And I covered this both in my IRA and in my margin account. As you can see, you can probably do just as well as I did, even though it was a couple of days ago. But in my margin account, I went in and sold the March 99 puts in there for 65 cents. March 99 puts for 51 cents, bought those back for 21 cents. And then in my IRA, I had on the March short 99 puts in there, long the 85 puts to define that risk. And originally sold that for 48 cents, bought just the 99 puts back for 21 cents. Sorry about that yesterday for that confusion. I started realizing when I saw the 23, I was like, wait a second, I thought that was the 28, and kind of got all screwed up in my own head. But it was UPS nonetheless. And that's all I got for you guys today. Other than if you can't take that, take it easy.